Let me start with a picture. Imagine you and I are standing on a beach on sunrise. The ocean looks calm, the sky is clear, and yet, if you look closely, you can see the current moving underneath the surface. That's exactly how early 26 feels to me. And today we are going to see how the global economy looks fine, growth is still positive, inflation is generally cooler than it was a couple of years ago. Central banks are not in a panic mode, but underneath, the current is definitely shifting. Technology is changing how companies hire. Politics is shaping inflation decisions, and global trade is being rerouted in ways we haven't seen in decades. Good morning, everyone. I am Alessandro, and I am the founder of Macro Mornings, where we are more than 53,000 investors. We are at the top 1% investing newsletter out there. I'm sure you're going to love it too. So you can find the link in the description to subscribe today. And I can wait to see you over there with the rest of the family. And today we are going to talk about how this new year scoreboard in a very short period of time. If I had to summarize the baseline outlook in one sentence, it would be something like this. The world keeps growing, inflation cools a bit more, and policy gradually becomes less restrictive. The global scoreboard many strategists are working with looks like this. Global growth is expected around 2.4% in 26, slightly lower than 2.6% into the last year. Global inflation is expected around 2.8% in 26, down from 3.1% in 25. Those are not exciting numbers, of course, but the base case is not a recessionary story. So when the baseline is calm, like this one, markets can get complacent. And after a period of unusually low volatility in late 25, a lot of research suggests 26 could bring more normal swings, meaning bigger up days and bigger down days, even if the economy stays okay. So, in my view, the real question is, will growth be fine? What could surprise investors, and how do I protect myself without missing the upside? And the biggest source of surprise in 26 has two letters: AI, the real growth engine that can also scare the labor market. You have probably heard people talk about AI like it's a trendy theme for tech stocks. I don't see it that way anymore, honestly. I see AI is a macro force, something that can change growth, inflation, and even employment, of course. But a real survive by UBS estimates that AI has increased US labor productivity by up to 1.3% since GPT became available. Now, 1.3 might sound small, but in macro terms, guys, it's not small at all. If productivity rises, the economy can grow faster without pushing inflation higher. Companies can earn more. For example, workers can produce more output per hour, and the speed limit of the economy becomes higher. That's the good side. But I also want you to see the other side clearly because it matters just as much for investing. The same AI adoption that helps productivity can also reduce hiring. UBS even points out that investment spending and job growth have started to diverge, meaning companies may be spending aggressively on technology without hiring aggressively into the real economy. So, in my view, AI can boost earnings and growth while also making the labor market feel weaker. And this is exactly why, even in a good enough economy, we can still get sudden risk off moments in markets. Because markets don't only price growth, they also price confidence. And confidence depends a lot on jobs. So let's bring this into the country that still drives global risk appetite, the United States. Let me let me give you a clean set of US numbers that matter for this year, in my view. One is the US growth forecast in 26, 2%, up slightly from 1.9% in 25. Inflation that goes down from 3% in 25 to 2.5% in 26. And that matters because rates follow indication. The same forecast sees the Fed policy rate from 3.63 to the end of 26 at 2.63. Even the US 10 Treasury yield from 4 to 3.75%. So, in a simple way, the baseline is still rates coming down, not rates going back up. Now, that's another layer that I think is definitely important today. They argue consensus might be too pessimistic on US growth. In other words, many people expect about 2% growth, but UBS thinks there is room for upside because the US economy has proven resilient. And there is very concrete support point. US fiscal legislation is expected to provide a $55 billion boost to disposable income through tax rebates in the coming months. That's real money. That's the kind of number that keep consumption steady even when headlines are noisy. So effectively, where is the real risk? The risk, guys, is not that inflation suddenly explodes again. UBS actually says if their outlook is wrong, the problem is more likely to be labor market weakness, not inflation overeating. That's why they like owning longer term bonds as a hedge. If the labor market softens quickly, bonds can cushion the portfolio. If 26 goes well, equities and credit can still do fine. If 26 goes wrong, it probably goes wrong through jobs. And in that case, having some bond exposure can help you sleep well at night. So there is also another risk that I don't want to ignore, even if it sounds political: central bank credibility. Some outlooks raise the concern that legal or political pressure could challenge the idea of a fully independent central bank. You don't need to predict the outcome to understand the market reaction. Credibility is slow to build and fast to lose. If credibility gets questioned, markets can demand higher compensation, which usually means more volatility, of course. So I'm not watching the fan only for rate cuts. I'm watching definitely it for credibility and communication. Now, let's go to Europe, where the story is just a little bit different. Europe in 26 is not crashing, but it's not also leading. This is objective, of course. The euro are numbers at a slower data. Growth is expected around 1.1 in 26 from 1.4 during the last year, and inflation from 2.1 last year to 1.8% this year. A policy rate again from 2% to more or less only 125 basis points, so 1.75%. And the euro is expected to be relatively around 1.17 to 18 versus the USD dollars. So what's the issue here? The issue, again, is not inflation. Europe has room to be accommodative. The issue is growth, quality, and competition, in my view. A big part of the outlook hinges on fiscal policy, especially Germany. Some forecasters highlight that Germany is expected to front-load infrastructure spending in 26 and 27, but the pace is uncertain. If execution is wrong and strong, sorry, Europe gets a meaningful boost. If it's slow, Europe stays stuck in a low growth lane. All right. And then there is the China factor, which we will talk about next because it's European manufacturing competitiveness. Now, the UK outlook is heavily tied to fiscal credibility, of course. And if you are an investor, the takeaway around the UK is is this one. The UK can look attractive, but if credibility is maintained, but it can also reprice quickly if markets worry about fiscal discipline. Now we are going to talk about just a little bit silence driver of inflation and competition in 26, which is China. So in China's growth are going something from 4.5% in 25 to 4.3% in terms of global GDP growth. Inflation is still very low, moving from 0.5 to around 1%. The policy rate is around 1% to 1.25, and the currency in that view moves from 7 to 7.20 per dollar. But the bigger point is that China is producing a disinflationary wave for the rest of the world. That's the reality. UBS puts it in a way that really sticks with me. In 25, Chinese export volume growth outpaced the rest of the world by a margin not seen since 2001, while export prices fell sharply. That comparison, 2001, is not random. It reminds us of a period where global trade dynamics helped it keep goods prices low for years, but also reshape competition for manufacturers worldwide. This is why China matters for your portfolio, even if you never buy a Chinese stocks. Cheaper exports can help global inflation fall, but again, they can also pressure profits in competing economies, especially in places like Europe. So China can be both a gift and a handshake for a global markets at the same time. And then we have market expectations as a outlook generally for 26. If you look at how big institutions are describing early 26, the tone is broadly constructive. They see upside growth with contained inflation as supportive for equities and credit. And UBS even notes that markets enter the year pricing more profitability of rate hikes across several advanced economies by Q4, meaning investors are not positioned for a deep slowdown. They are positioned for a world where growth holds up. But the same research also emphasizes that returns could be harder than people assume because valuations are already high in many risk assets. I want exposure to the upside because the baseline is not recession, but I also want protection because the most likely break is jobs, not inflation. That's why the hedge conversation matters. All right. The lesson for this year, in my view, I think, is that 26 is not the year to be unaged, but because growth looks fine. Because fine economies can still produce sharp drawdowns where positioning is crowded or when one weak link breaks. And in 26, the weak link I keep watching is the labor market, especially if AI adoption quietly reduces hiring faster than people expect out there. Let me end this episode today with a simple metaphor. If 26 were a long road trip, the weather forecast would look pretty decent. No hurricane on the map, no guaranteed storm, but the road still has sharp turns. All right. So I'm not here to predict one perfect outcome. I'm here to help you prepare for more than one version of the year. Because the best investors, guys, are not the ones who guess the year correctly. They are the ones who build portfolios and habits that can survive the surprises and still capture the upside. If this kind of macro storytelling keeps to you, you're going to love my free newsletter, Macro Mornings. It's read by over 53,000 global investors out there, people like you that want more than noise. They want clarity, insight, and strategy. And it's completely free. You can find the link in the description and you can subscribe totally free today. I'm going to wish you a great day and see you to the next one episode. Thank you very much. Have a nice day. Bye bye.